Assalamualaikum and greeting to our lecturer Puan NORAINI and my friend. Today, we will present for our subject DPA 30073 Cost and Management Accounting 1. For our presentation, Topic 1. We have 6 members in this team, which is myself. My name is Nur Shahira binti Iftikar Ahmad Khan. My matrix number is 01G8020F2002. And my group member is nnorbainun, Siti Nur Karisa, Karsina, Kairunisa, and Amira Sofia. So, this is the content that we will present today. 1.1. The concept, principle, method, and techniques of cost. And 1.2. The calculation of the cost, accumulation, and cost assignment. Without further ado, let's start our presentation. So, the first one, what is definition of cost accounting? Cost accounting is the establishment of budgets, standards, costs, and actual costs of operation, processes, activities, or product, and the analysis of variances, profitability, or the social use of funds by CIMA London. And cost accounting is a quantitative method that accumulates, classifies, summarize, and interprets the information for 3 major purposes, which is the first one, operational planning and controlling. The second one, spatial decision. And the third one is product decision by Charles Thomas Holmgren. So, we can classify that cost accounting is cost determination activities involve the costing of a product, object, process, service, or operations. So, the next one is the importance of cost accounting to management. Why is cost accounting is so important? Because it can identify where it spends, how much it earns, and where money is being lost. Number 1 is facilitating controlling. Cost accounting provides detailed costing information to help the management maintain effective control, increase efficiency, and check wastage and uses. Knowledge of the cost is also necessary to check on the cost of product and control wastage. By using cost accounting data, the unprofitable activities are being identified so that corrective action may be taken. Number 2, facilitating planning. In developing plans for the future, cost accounting will be used to analyze the cost of past operations and production to plan future costs. The relevant historical costs must be adjusted to reflect any changes in future production. From that point, the management will determine the activities that are to be carried out in the future, and a formal plan called a budget will be adopted. Number 3, ascertaining cost and guiding selling price fixation. One of the major factors that affect price determination is the cost of production. Cost accounting provides information regarding the cost to make and sell a product or provide a service. The total product and cost per unit are important in deciding the selling price of a product. The last one is can provide information for short-term and long-term decision making. A cost accounting system provides cost information to facilitate decision making. The decision making process involves searching for alternative courses of action, evaluating them, and then selecting the best among them. Accurate cost information is important in decision making for distinguish between profitable and unprofitable activities.
Assalamualaikum warahmatullahi wabarakatuh. My name is nnorbainun binti Hassan and matric number is 01D8020F2003. I will explain about the differences between cost accounting and financial accounting. I will go to the definition first. Cost accounting is the field of accounting that is used to record, summarize, and report the cost information on a periodical basis. Its primary function is to ascertain and control costs. It helps the users of cost data to make decisions regarding to the determination of selling price, controlling costs, projecting plans and actions, efficiency measurement of the labor. Cost accounting adds to the effectiveness of the financial accounting by providing relevant information which ultimately results in the good decision-making process of the organization. It traces the cost incurred at each level of production, right from the input of the material till the output produced. Each and every cost is recorded. Next, financial accounting is the branch of accounting which keeps the complete record of all monetary transactions of the entity and reports them at the end of the financial period in proper formats that increases readability of the financial statements among its users. The users of financial information are many, from internal management to outside parties. Preparation of financial statement is the major objective of financial accounting in a specified manner for a particular accounting period of an entity. It includes income statement, balance sheet, and cash flow statement, which helps in tracing out the performance, profitability, and financial status of an organization during a period. Secondly, the differences between cost accounting and financial accounting is the purpose. The purpose of cost accounting is provides information for stock valuation, decision making, planning and control, also to ascertain and control costs and maximize efficiency. Meanwhile, for financial accounting, the purpose is provides information on the financial position of an enterprise, also prepare a profit and loss account and balance sheet. Thirdly, scope of accounting information system for cost accounting is focuses on present and future data. For financial accounting, scope of accounting information system is reports on what happened in the past to draw up financial statement, which is historical data. Fourthly, target users for cost accounting are internal users, such as managers, and for financial accounting are external users, such as shareholders. Then, regulatory requirements for cost accounting is no mandatory rules or regulations are required to be adhered to for preparing reports. Any accounting techniques that generate useful information can be used. Regulatory requirements for financial accounting must follow regulatory requirements such as Companies Act, financial standards, and GAAP when preparing financial statements. Next, cost accounting recorded according to cost functions and cost units. For financial accounting, proper ledgers maintained for expenses, income, assets, and liabilities. Then we have unit of measurements, monetary and non-monetary such as machine hours and labor hours for cost accounting, and monetary units only such as ringgit Malaysia for financial accounting. Next, no specific format for cost accounting. They are prepared in the format decided internally by the firm, in the format which more suits the users, and for financial accounting, the financial statements are prepared in the format prescribed by regulatory bodies. Accounting method used for cost accounting not based on the double entry system. Meanwhile, for financial accounting follows the double entry system. Last but not least, for the differences between cost accounting and financial accounting is segmentation. Cost accounting reports focus on small parts of the organization, such as customers, and financial accounting reports describe the whole of the business.
Assalamualaikum warahmatullahi wabarakatuh, and hi everyone. My name is Siti Nurkhalisa binti Muhammad Musa. My metric number is 01D8020F004. Now, I will explain about basic cost concepts of costing principle. There are 8 elements of costing principle, which is cost unit, cost center, cost object, conversion cost, opportunity cost, incremental cost, replacement cost, and lastly, sunk cost. Now, let us go through one by one. The first one is cost unit. Cost unit is a quantitative unit to which cost can be associated. For example, a liter of petrol. Next is cost center. Cost center is sections or departments to which costs can be related. For example, production and service cost center. The third one is cost object. Cost object is something to which costs are assigned. It is the cost allocation related to the product, services, and departments. For example, product lines, geographic territories, customers, and departments. The fourth is conversion cost. Conversion cost is the sum of direct wages, direct expenses, and manufacturing overhead costs of converting raw material from one stage of production to the next. In other words, conversion cost is work cost minus the cost of direct materials. Now, we move to the next point. My next point is opportunity cost. Opportunity cost is the benefits of an alternative given up when one decision is made over another. It is most relevant for two mutually exclusive events. For companies, opportunity costs do not show up in the financial statements but are useful in planning by management. The next point is incremental cost. Incremental cost, total cost incurred due to an additional unit of product being produced, such as raw materials for one additional unit of production. The next one is replacement cost. It is referring to the amount of money a business must currently spend to replace an essential asset. For example, real estate property, an investment security, a lien, or another item with one of the same or higher value. Insurance companies routinely use replacement cost to determine the value of an insured item. Last but not least is sunk cost. It is cost that a company has committed to and are unavoidable or unrecoverable costs. Sunk costs are excluded from future business decisions. For example, survey costs for marketing purpose.
Assalamualaikum warahmatullahi wabarakatuh. My name is Karsina Binti Ahmad. My metric number is 01D8020F2009. I will continue our presentation with the definition of cost accumulation. Cost accumulation is the process of collecting all cost information about the business with the help of the cost accounting system. It is a process of collection of all relevant data regarding the various costs incurred by the company at various stages of production. This calculation is the result or outcome of the cost accounting system prevalent or practices in the company. Next, definition of cost assignment. Cost assignment is the allocation of costs to the activities or objects that trigger the incurrence of the cost. The concept is heavily used in activity-based costing, where overhead costs are traced back to the actions causing the overhead to be incurred. The cost assignment is based on one or more cost drivers. The other's name for cost assignment is cost allocation.
Hello, my name is Karunisa Binti Musa. My metric number is 01D8020F2014. Today, I will explain about cost accumulation for the purpose of stock valuation and profit reporting. So, what is the meaning of cost accumulation in accounting? Cost accumulation is the process of collecting all cost information about the business with the help of the cost accounting system. This calculation is the result or outcome of the cost accounting system prevalent or practices in the company. Next, I will explain about product cost. Product costs are costs identified with goods produced. Product costs are initially identified as part of the inventory and include all costs that are involved in manufacturing a product. So, basically, product cost is a necessary and integral part of producing the finished product. The components of product cost consist of direct material, direct labor, and manufacturing overhead. From the previous slide, I had explained the meaning of cost accumulation and product cost. Now, I will explain about the cost of period. Period cost is the cost deducted as an expense in the current period without ever occurring consider part of the inventory. Period cost, as well called non-manufacturing costs. All non-product costs. For example, sales commission, sale expenses, advertising expenses, travel entertainment expenses, and administrative office rental costs are period costs. Period costs are not included as part of the cost of whether the goods are purchased or manufactured. That's all for me. I will pass to my next friend.
Assalamualaikum warahmatullahi wabarakatuh. My name is Amira Sofia binti Abdullah. My metric number is 01D8E20F2017. I'll be continuing our presentation with a discussion on cost accumulation for the purpose of decision making by using high-low method. First, what is high-low method? High-low method is a way of attempting to separate out fixed and variable costs given by a limited amount of data. This method involves comparing the total cost of each level of the highest level activity and the lowest level of activity. The cost function formula for the high-low method is y equal to a plus bx, which y is a total cost, a is fixed cost, b is variable cost, and x is volume. The first cost is a fixed cost. Fixed cost is a cost that is remain unchanged even when production activities change over a certain relevant range. Fixed cost is also well known as period cost. Given example of fixed cost is such as rent, insurance, salaries, and wages. The formula for fixed cost is A equal to y minus bx. The graph given in the slide shows that the cost is fixed. Second is a variable cost. Variable cost is a cost that changes directly when the production activity changes. The example for variable cost is timber, carpenter, machine, and more. The formula for variable cost is B equal to y minus A divided by x. The graph in the slide shows that the cost is variable. Lastly is a semi-variable cost. Semi-variable cost is a cost that varies with the production but not in direct proportion to the volume. As an example, supervision, inspection, and maintenance. The graph shows about the cost that is semi-variable.
Next, I will explain cost accumulation for the purpose of planning and control, which is controllable costs and non-controllable costs. Controllable costs are those cost items that can be managed or altered in the short-term period through specific management decisions. In other words, a cost is regarded as controllable if a manager has the authority to decide on its incurrence or non-incurrence, or to decide on the amount of cost that must be incurred. The management can thus alter this cost on a need basis. Controllable costs can include direct variable costs, other employee costs, and marketing costs. Controllable costs are identified at each managerial or decision-making level. This is because what cost is controllable for one manager may not be for the other. For example, training costs may be determined by senior management personnel and thus would be controllable at this level but may become a non-controllable cost for the production manager. Non-controllable costs are those costs which cannot be avoided or altered by management decisions, especially in the short run. The major reasons why a cost become non-controllable are that it is either fixed in nature or arises as a result of some kind of mandatory influence or power of one or more external parties. The costs that qualify as uncontrollable due to their fixed nature include those expenses that have been committed and must be incurred irrespective of the level of output the business generates. Examples include rental payment, interest on a long-term loan, and periodic depreciation charge. That's all from us. Thank you.